In this presentation, we will use tax software to input dividend income. We will be using Lacert tax software owned by Intuit, the owners of QuickBooks, but the data input process or the format of it and the use of the software is similar with other software as well. Typically, the data input form will be a 1099 dividend. It'll be a fairly straightforward form, looks something like this, although the format of it, the look and feel of it, the shape of it may be different. The data input fields will be the same. It should have somewhere on it saying it's a 1099 DIV. If it doesn't say 1099 DIV, then it's not the formal 1099 statement. You might have other statements from the broker that says something, that reports dividends and whatnot. But the broker should be required to, the institution, the financial institution should be required to give you the 1099 DIV. If you don't see that on the form, then you'd probably want to request that because that's the thing that's going to be given to the IRS, and typically they are required to provide that. So that's what you're looking for. May look a little bit different in format, but you should see that on it somewhere. Then you'll have the numbers involved into it, and typically, if nothing else, you'll have Box 1A and Box 1B. Those are the critical two forms. You may have some of these other informations, and we might talk about a little bit of them briefly later, but these are the two main components that you're going to have. And you'll recall that we have the dividends up top and then the qualified dividends. Now, the dividends will always be greater to or equal than the qualified dividends. So, for example, if we had 10,000 in dividends, this would be 10,000. This would be 10,000 if they were all qualified. If 400 of them were qualified of the 10,000, 10,000 up top, 4,000 down below. The 4,000 would be part of the 10,000, but only the part of the 10,000 which would be qualified. So let's take a look at what that would look like. Here we are in our mock 1040 where we have the James Smith. We have no dependents, filing single. We have the 100,000 in the wages. We're only taking the standard deduction at this point of the 12,200. Currently the income at 87,800. We're now going to be considering this line up top with the dividends, which is line 3, where we have the qualified dividends and the ordinary dividends. So let's start off with just having ordinary dividends. So if I jump to this screen, I'm going to jump in to the screen to the dividends. And I'm going to make this a little bit larger. Now this probably come from a broker. I'm going to call it Corporation 1 or Company 1. And I'm going to say that we have ordinary dividends here. And let's start off with 500 of ordinary dividends. Now I'm not going to put anything in the qualified. I'm just going to keep them as the ordinary dividends. Then I'm going to jump back to the forms. Let's see what happens. Back to the forms, we see in line 3, we've got the ordinary dividends here at that 500. We had the wages at the 100,000. We've got the dividends bringing it up by the 500 to bring us to basically the taxable, to the total income, 100,500 minus the standard deduction, 12,200 gives us the 88,300. We could see that fairly easily on our calculation over here in our worksheet, where again, we'd start off with the 100,000. We got the 12,000 here. Now I'm going to say, all right, we've got income. I'm going to bring it down here into our input screen, and I'm going to say that we had 500 in dividends. 500 in dividends. Go back to our tax form. Now we've got the 1,500 basically in line 1 minus the standard deduction. That brings us to the 88,300. And so that's what we would think would be our taxable amount here. Then on page 2, we actually calculate the tax and think about the payments and credits. Note the tax calculation here would simply be using the ordinary income progressive tax structure with the multiple tax rates depending on the filing status, because the dividends were not qualified, and therefore we don't have that added kind of problem of having the tax rates being between 10%, 15% and 20%. Let's go back to page 1. Also note that we don't have any Schedule B being triggered here because it's not over that 1,500. So let's bring it over the 1,500 now, and that would mean that there's a significant amount of investments. Remember, this is our investment income, and that would mean that the IRS is saying, okay, now I want more information. We might have multiple statements to bring us over that amount. If I go back to the data input screen, let's say that we add another one and say we now have Company 2, and let's say that this one was for 1,700. And again, we're not going to put anything in the qualified at this point. Let's see what happens. We then jump over to our forms. And now we have in here, we don't have anything in 3A because nothing's qualified. It's now 2,200. And we see now in the Lacert software that it now has populated and made bold Schedule B. If we go into Schedule B, we're now required to fill out the first half, you'll recall, is the interest half. The second half is going to be the ordinary dividends. Notice these are both kind of the investment type of passive income. If someone had more money, they would put money either into the bank, into longer term savings accounts where they can generate interest, or to companies typically in the form of investments in stocks and be receiving dividends, returns on the investments to the owners, the shareholders of the investments. So now we have these two that will be lined up, giving us more information. That totals out to the 2,200. That then pulling over then to line 1 of the 1040, there's that 2,200. Now and if we were considering the actual form then, that would be an indication where these 1099 forms, you would have basically 2,200 in the two different 1099 forms, only in line 1, nothing in line 2. Now let's consider we have the second 1099 form has an amount populated in line 2. But before we do that, let's consider this in our software over here. So we said that we now have 1,700. So if we were going to go back to our worksheet and double check it, we'd say, all right, now we have another one, 1,700. And that brings us to that 2,200. Our total then, 202,200. That brings us to the 202,200 minus the standard deduction. You would think 90,000. Back to the tax form. And we'd go up top and we could say, all right, that's an easy, we can double check that number. Again, the tax calculated on it all at the progressive ordinary income rates, because nothing is qualified. Now let's take the consideration where of that 1,700, let's take some portion of it that will be qualified. So we're going to say that some portion, let's say 1,000 of it is going to be qualified dividends. So that would mean that we would have 1,700 up top. Box 2, we're gonna say 1,000 of is qualified. So 1,700 would be all of it. The 1,000 of it would then be qualified. To put this into the data form, it's straightforward, right? We'd go back into the data input. We'd say, all right, now box 1 had 1,700. That's the total ordinary dividends. Box 2 then said 1,000. So 1,000, that's going to be in the qualified dividends. And you can see the boxes down here. Most software will actually label out the boxes in some way, shape, or form. Lacert puts the quick data input up top and then kind of the more box layout down below. Let's see what that does to our forms. If we go to the forms then, we're going to say now we still have that 2,200. Didn't change the bottom line at all. We're still at the 90,000. So didn't change the bottom line at all. We're at the 90,000. However, now we have this added information of the qualified dividend at the 1,000. So we've got the qualified dividend now at the 1,000. So now the question, and then of course if we go to Schedule B, we still have the 1,700, which is total dividends, and the 500 total dividends adding up to that 2,200, which carries over to the 1040 here on 3B. So now the question, of course, is, well, why would we even put the 1,000 amount here when there's been no change to the bottom line, basically net income number, with that information? Is it just an informational type of thing? Well, it's not just an informational type of thing this time, because it does affect the tax calculation, and that's going to be dependent on our filing status and our taxable income, as you can see by this schedule. So that's not something that, when we enter this in the software, it's probably going to do it for us. It's going to do the tax calculation for us, but we need to be able to explain that. It's going to be more of a complex tax calculation. So to do that, to look at it, let's just consider this intuitively from just a data input standpoint. Let's first remove the qualified dividends. So I'm going to go back over, and I'm going to say, well, what if I have no qualified dividends, and I go back to the tax forms? I'm still at 90,000 there. That didn't change. But if I go to page 2 and look at the actual tax calculation, I'm at 15,781. Let's put that in our Excel sheet. I'm going to say, all right, the tax calculated was 15,781. All right, and so there's that, no problem. Then I'm going to go back over here and say, now let's go back and change this and say that of that 2,200, 1,000 of it is qualified. So what's going to happen? We're not going to see any change here, but we will see a change here. Okay, and so I'm going to go back over and say, all right, let's go back in here, and we're going to go that this is going to be 1,000 of that is qualified. So now I'm going to go back to the forms and say, all right, taxable income didn't change. It's still at the 90,000. If I go to page 2, however, there has been a change to the actual tax calculation. You'll recall last time it was 15,781. Now it's 15,691. And that's because the program had to actually remove the amount that's what's qualified, the $1,000 of it, and tax it at a different rate. And if you want to see that calculation, then you can go into the worksheet here and you can say, enter the line from the 1040, there's the 90,000, into the amount, line 3A, there's the 1,000 that in essence it's pulling out from line 3A, and then in essence it's going to be applying the progressive tax rates to the 89,000 based on the filing status and the progressive tax staples and whatnot. And then it's going to have to take the 1,000 and apply whatever rate is applicable, depending on either 0%, 15%, or 20%. And you can see that calculation down here. Now, if you read this line by line, it's going to be, you'll be able to get to that. But obviously, this is a very complex, kind of formula to get to that calculation of it. But if you read through this line by line, you'll get to that. You can see our percentages here, 15 and 20%. Based on the 1,000, and it actually taxed it, as you can see, at the 15%. And that's because if we close this back out and we go to box 1, we've got the 90,000 for a single individual, and the 90,000 for a single individual is higher than the 39,375, but below the 434,550. And therefore, it's pulling out this 1,000 in essence from the progressive tax system and taxing it at that 15% rate. Now, why is that beneficial? You can at least tell the taxpayer, you can say, well, why is that beneficial? And note, you can do this in the tax software if you're doing this with the client. You can say, well, why is that beneficial? Let's isolate the line that's beneficial on it. It's going to be, this number is going to be the same. Second page is going to change that number. Is that beneficial to you? Well, it looks like it's applying the 15% tax rate because it's a qualified dividend, because it looks like you got that 1,500 on the 1,000. Is that beneficial to you? It should be, because that's the point of it. But let's go to the tax summary sheet and we'll take a look at your average tax rate, which is 17.4. Some of your tax is below that, some of it is above that, but on average you're paying 17.4. 15 is below that, and your top tax rate is 24%. So if you taxed another dollar, it would be taxed at 24%. 15 is far below that. So again, the point here is that the code is trying to say, we know there's double taxation. We want to incentivize investing into corporations. Therefore, we're going to have some tax rate. You're still going to be taxed because it's passive income. However, we're going to give you some kind of benefit, and whatever your income is at, the benefit should be such that your tax will be equal to either 0, or if your ordinary income is that, or lower than the individual tax rate that's being applied to you. Now, note on the 1099 dividend, and this is going to be stuff that you're going to get from the broker, so you might have a statement that has basically interest on it and dividends on it and whatnot. And if you see, it'll have the 1099 interest and the 1099 dividends basically on the same page. And you might see something then that has these boxes, box 2A and 2B and such, that are going to be, for example, 2A, total capital gain distribution. Why would that be on with the ordinary dividends? Now, note that the ordinary dividends usually comes out of retained earnings, the accumulated earnings of the corporation. But it's possible that if something happens and they dip into the capital or something like that, then it's really not an ordinary dividend, because they're giving out basically the original investment. So the bottom line there is that you're going to have some kind of distribution in this format, which is going to be possibly, it's similar, it's being paid out by the corporation, therefore it's going to be given on the 1099 form, on the 1099 dividend, and it should be fairly easy to enter into the system, although it'll populate possibly in some other area. So let's just take a look at that in Lacert. Let's say we had in box 2A, you had, let's say 1,202A. So we're going to say, all right, let's go to our data input form. And we're going to say, now we got box 2A. So I've got the capital gain distribution, which is also in the screen up top. And I'm going to say it was on the same company B. So we had ordinary dividends qualified dividends, and then we have, what did I say, 1,200. Let's just put that there. Now, if we populate that, now it's going to be populated in the same field. Most data input forms will have that same field populated. If I go into the forms, then I go up top into the forms, we see no change to the dividends, the 1,000 and the 2,200. What we do see a change to is the capital gains or loss, and it might be populated then also Schedule D related to that. And Schedule D has to do with when we sell stocks, basically. So in essence, what's happening here is it's kind of like if there's a you can think of it basically a distribution happened, but the distribution wasn't out of the retained earnings, and it was out of the capital, the initial investment in some way, or possibly it was treated as kind of like a sale. So it will be typically income. It'll be on the Form 1099 dividend, but it's not technically really a dividend. It's going to be reported down here as capital gain and may be supported then on the Schedule D. We'll talk about a Schedule D in a future presentation, but you would expect to see that, and you'd expect to see it basically down here. We see it on line 6, the 1,200.